company on Money News. You're listening to James Willis across our network, and the fallout from Labor's tax reforms from the federal budget continue. And I have to say, every day there's a new consequence or a new scenario that you have to wonder if anyone in Treasury actually even considered. The outcomes and the consequences and the people impacted by this are far broader than we first thought, including the fact that any investment property bought before September 1985, still owned to this day, would from the start of the 2027 financial year, so from July 1, 2027, be subject to capital gains tax for the very first time. However, it turns out that every real estate investor is most likely in for a shock next year because, as we know, the property market has fallen in some suburbs by 5%, in the high-end suburbs in some areas of Sydney and Melbourne by 10%. Now, it will climb back up property, but that could take some time. And by the time it's on its way back up, any increase in value beyond July 1, 2027 will be subjected to a larger tax on capital gains. This is complicated, but we need to spend some time on it tonight. Gary Brown is a chartered accountant and the CEO of Hatcher Advisory. He's on the line for us tonight. Gary, thanks for your time.
Thanks, James, for having me.
Now, be honest, in your office and in your industry, are you going through and brainstorming and wargaming a number of different scenarios? Because every day there's a new amount of people impacted.
We actually are. And, we have 700 family groups, and it's complicated for all 700 family groups. And even just the average mum, dad person are getting impacted because you could be 30, 40-year-old and you're impacting your parents or your grandparents, and it's having that whole impact across the whole family.
Yeah. Now, just be honest, for the whole time you've been in this industry and in the field of being a chartered accountant, can you recall a more confusing or drastic set of tax changes from the government, or is this the biggest in your time?
In my professional career, so for the last 15 years, this is the biggest change that I've seen, and biggest change since GST, to be honest. So, and if you look at it, the budget was announced without detail, and we're still lacking detail on how do we roll over, or what our exemptions are doing, rollovers out of trust into companies or whatever that may look like. So giving advice to people, and I get emails once every 2 days, I get emails from clients about it. And I'm like, how do you give advice if the legislation hasn't been passed for all of the items and we don't even know what the legislation is for rollovers? So it's pretty hard. Never had this before.
Let's go through a few different scenarios, and then I'll ask you about trust at the end, but just on capital gains tax, because I know you've done some rough sums. Let's say the asset was bought before 1985. This will be captured by capital gains tax for the very first time from July 1 next year. What is the situation for someone who may have bought a property before September 1985?
Yeah, this one's tricky because the pre-CGT assets will be exempt all the way up until the 30th of June 2027 for capital gains. But we then have to do a market valuation. And if you think about what's happening in the property market at the moment, property prices are going down. So you're going to do a market valuation where the property price has been reduced, and all of that's going to be exempt. But then what's going to happen, 1st of July 2027 onwards, you'll start paying capital gains, or you'll have a capital gains tax applied when you sell that property. So you're going to have a lower value property when we do the valuations, when the valuer does it, and then it's going to hopefully go back up, and then you're going to get taxed on that uplift. So it's going to be a fascinating time. And remember, capital gains will get taxed at a minimum 30% regardless of your income level.
Okay, so let's say that there was a house that was purchased. Hang on, let me just make sure I've got this. Okay, so in the rough scenario that you've played out for a house that was bought before capital gains tax, the original cost was $100,000. The market value from next year is $1.35 million. By the time it's sold in June 2028, it'll be 1.5. In that scenario, someone is paying what value of capital gains tax for the first time?
Yeah, so in that scenario, would pay an estimated $25,000.
Hey, sorry, I'll just interrupt. It's better. I reckon it's better if you go through those numbers.
Sure. I
and
can
just
do.
go and just literally in that chart. So just take a house bought and just you go
Yeah,
through it now.
I'll do it. So James, think about this. If we had a house bought pre-CGT for $100,000, it went up, it went up to $1.5 million in say 2025. It's sitting at 1.5. But then these changes come in. So now, based on these changes, we'd have to get a market valuation in 2027 for, and say it came in at 1.35 because the market's going down. So we then sell the property for 1.5 million. We've got this capital gain. Everyone's happy about a capital gain. But the reality is we would have a pre-CGT exemption for 1.25 million. So everyone's happy about that. But then we'd have a post 2027 gain of 150,000 less an indexation of 67,000, which would give us a net capital gain of 82,000 and then a tax of 25,000 for the first time. And if that sounds complicated, it is complicated. And I think maybe, from viewers and listeners out there, it's going to be a complicated period of time selling pre-CGT assets moving forward.
Yeah, and this could be someone that is a pensioner or someone that is this could be someone that is in the retirement stage of their life, more than likely, and they're in a situation now where all of a sudden their accountant is saying, hey, by the way, from next year and beyond, you're going to be hit with a new tax on your single investment property that you've never had to pay.
Correct. And that will be, like, again, if we look at my client base, it is mostly people that are around that 60, 70 mark that have pre-CGT assets. So it's definitely going to be hitting a lot of families out there.
Okay, in scenario 2, which is a house bought in, let's say, 2020, at the start of 2020, when COVID began to kick off, a lot of people invested in property that year. Go through the same numbers and explain how the tax has increased.
Yep. So again, we'll just say we purchased a property for $1 million, keeping it simple. And let's just say in 2028, we sold it for $1.5 million. So we've got a $500,000 capital gain. So everyone would be happy with that. And then when we look at that and we say, hang on a second, we used to get the 50% discount. So for the first six years of owning that asset, we'll get a 50% discount on that amount of money, which would equate to around that 350,000 less 50% discount, $175,000 as a net capital gain. But then we have the post 2027 gain, which is 150,000 as well. So what ends up happening is we have a total capital gain of 257,000, and we would get taxed on that. Keeping in mind that the tax there is going to be minimum 30%, which means that we're going to be paying between $80,000 and $100,000 in tax.
So in that situation, you are no longer eligible beyond July 1 next year for the 50% discount, and therefore your tax increases by how much?
Yeah, it's going to be significant. At least, in this example, it's going to be 2-3 times more tax.
What complicates this story a bit as well, Gary, and I think this is where a lot of our listeners have woken up to what is going on, is that for someone, let's say they've got $1 million house that they bought 5 or 6 years ago, it's an investment property. Suddenly, with the tax changes and 3 interest rate rises in a row, that house may only be worth $950,000, or in some parts of the country, as little as $900,000, or that could still be coming because there's a view we haven't bottomed out just yet. Now, investors have obviously been scared off all in one go, but property will rise. By the time the property starts to rise again, they're inevitably going to be captured by this new tax from July 1 next year.
Correct. And this is what the problem is, that if you look at CBA forecasts, they forecast the market to go down for the next year and a half. So if we're doing market valuations at 30th of June 2027 and the market's gone down today by 5%, 6%, and then there's that bounce, it's like a perfect storm for the ATO to make a lot of extra money for free.
Say that again. That's unbelievable.
Right. So
that's the situation that we're in. And also for someone that may have lost $50,000 off the value of their home over the last few months, by the time it starts going up again and they go back into the green and start growing the property again, they're going to be paying double the tax in some cases.
Yeah, correct. So they're going to, the property goes down, they're going to hold on to it. We do a market valuation at 30th of June 2027. The property goes up, and then you're in this new system of taxation, which will make you worse off.
Just on these new valuations, which are part of the legislation on all investment properties, and I think there's about 5 million investment properties in the country. When does this start? And you're talking about July 27. What do you know about this, though? What's it for? And critically, is it mandatory?
Ooh, great question. Mandatory, the answer would be yes, and you would have to do it. You'd have to do it when we either at 30th of June or around 30th of June 2020, 2026 to get that market value of that asset. And you will need it when you lodge the tax return when you sell that asset. So what we would, as an accounting firm, we would recommend, and we'll send out emails to this accord, that all of our property investors get valuations based at 30th of June 2026 within maybe 3 or 6 months, so they can make sure it's accurate, and then to hold on to them for when they sell the property in the future.
Okay, but is this now an annual requirement? And if so, why? What is the purpose of having an official valuation from now on?
Got it. So it won't be an annual requirement. It will be just that once off to get that market valuation when we're changing the way we're taxed on investment properties.
Understood. Okay, that makes more sense. Now, will that valuation from an expert improve or increase people's values, or is it likely to do the opposite of that?
Well, I don't know about you, James, but every time I get a valuation done, the valuer values it at less money than I was hoping for. So, I'd be hesitant to say if you bought a property for $1 million and asked them to value it the next day, they're probably going to value it at a lower price point. So it could have that effect where the independent valuer values at a lower price point than what the market is, and the market's already gone down.
Just a couple of things on trusts. Firstly, the government recently took credit for a spike in newly created businesses. This is in the last couple of months, linking this to strong economic growth and their own policy decisions. Is it more likely that this is because people are starting businesses, opening up business names so they can move away from traditional trusts?
Absolutely, 100%. That when you look at the statistics of new companies getting set up or new businesses getting set up, you got to keep in mind that this is the biggest changes we've had in tax in the last 26 years. And again, like even my firm alone will probably set up 100 or 150, sorry, 1,000, 1,500 companies in the next 12 months. And I'm guessing less than 5% would be new businesses.
So what's the advantage of being in a business instead of a trust from now on?
Yeah. So the trusts don't really work moving forward. So first of July 2028, trusts are going to be a bad word. And what I mean by that is you have the minimum tax at 30%. More likely than not, you'll end up paying, say, closer to 47%. And if you use a trust to bucket money, you'll be paying 51+% of tax. So because of those reasons, you're better off under the new law. You'll be better off having a company, capping the tax at 30% on whatever your investment income is, and at 25% for the majority of small businesses out there, they'll pay 25%. So significantly cheaper than running a business under a trust.
Do you share the views from other financial advisors as well that the new tax on trusts could extend to some local community organisations, junior sporting teams, dance clubs, scouts, and some of them could potentially be paying more tax under this minimum trust tax of 30%?
Yeah, so definitely subject to how they're set up, but we do have clients that are part of those type of community groups, and they would be impacted.
Very, very interesting. Gary, it was great to spend some time on that this afternoon, and I really appreciate you joining us on Money News tonight.
No worries. Thanks, James.
It's Gary Brown joining us on all things CGT. He's a chartered accountant and the CEO of Hatcher Advisory. Thanks, mate. We got there. I'll tidy all that up so it sounds nice and schmick for tonight.
Perfect. Thank you.
Perfect. Thank you. Bye-bye.
See you, mate. Bye.